Hello, financial enthusiasts! Welcome back to Stock Market Catalyst, where we reveal the secrets to financial success in building a solid foundation for a brighter future. In today's video, we're diving into the world of investing basics with a focus on covered calls. Whether you're a beginner investor looking to expand your toolkit or a seasoned trader seeking to explore new strategies, understanding covered calls is essential. A covered call is a strategy involving the sale of call options on securities such as stocks or ETFs that an investor already owns. This strategy is favored by many investors due to its lower risk compared to other option strategies. In a covered call strategy, the investor holds or acquires shares of stock and simultaneously sells call options, typically at a strike price higher than the current stock price, to receive a premium. If the stock price surpasses the strike price of the sold option and the option is exercised, the covered call writer is obligated to sell the stock at the strike price. However, if the stock price does not reach or surpass the call strike price or even declines by more than the premium received, the trade can still be profitable. Let's consider an example to illustrate the concept. Imagine an investor who holds 100 shares of stock priced at $100 per share. After conducting a thorough analysis of the stock's price movement and trends, the investor anticipates limited upward movement in the stock price over the next few months. To take advantage of this situation, the investor decides to sell a call option on their stock with a strike price of $105. By selling this call option, the investor receives a premium of $300. Now, depending on the subsequent movements of the stock price, one of two outcomes will occur. If the stock price remains below $105 until the option's expiration, the option will become worthless, allowing the investor to retain ownership of the stock. In this case, the investor keeps the premium received from selling the option, which can help offset any potential losses incurred on the stock, considering commissions and fees. However, if the stock price surpasses $105, the option is likely to be exercised, and the investor will be obligated to sell their shares at the strike price. Despite losing the opportunity for further gains on stock, the investor still benefits from the stock's price appreciation up to the strike price, in addition to the premium received from selling the option after accounting for commissions and fees. This illustrates how a covered call strategy can provide investors with potential income generation and risk mitigation, offering a way to profit even in scenarios of limited stock price movement or a modest price increase. However, it is important to acknowledge the potential downside of a covered call strategy. By selling a call option with a strike price below the potential future value of the stock, there is a risk of missing out on further gains if the stock price continues to rise significantly. Additionally, as with any stock ownership, there is always the inherent risk of the stock price declining. It is worth noting that a covered call strategy not only generates income on existing stock holdings, but can also be used when purchasing new stock. Some investors opt for a simultaneous approach where they buy the stock and sell a covered call on it at the same time. This is referred to as a buy-right strategy, and it can be advantageous in reducing the effective cost of acquiring the new stock position. Consider an example to demonstrate this notion. An investor decides to purchase 100 shares of a company's stock at $100 per share, resulting in a total investment of $10,000. Simultaneously, she writes a covered call and receives a premium of $500. This premium reduces her effective cost to $9,500, excluding commissions and fees. Suppose she continues to write covered calls every month and consistently earns a similar premium amount each time. As long as the stock price remains below the strike price of the covered call, the cumulative premiums received over time after deducting fees and commissions can help offset some of the initial cost of acquiring the stock. However, it's important to note that there is no guarantee of consistently generating the same premiums month after month. Short options can be assigned by the counterparty at any time before expiration. And that concludes our discussion on covered calls. We hope you found this video informative and gained a better understanding of this popular options strategy. If you enjoyed this video and want to learn more about options trading or other investment strategies, we encourage you to explore our channel for a wide range of educational content. Thanks for watching, and we'll see you in the next video.